Friday, May 5th, 2017, Monaco 64, home of alternative economics and contrarian views. So it's around, well, it's midday exactly, London time, in an hour and 30 minutes. We've got the main number for the week, the US non-farm payroll for April. That usually moves the market around in the short term. A lot of volatility once that number comes out. It's expected, let's say, manufacturing, non-farm payroll is expected to rise 185. Previous number was 98,000. That was a lot lower than expected. Unemployment rate, 4.6%, expected to rise from 4.5. Of course, that unemployment rate doesn't reflect the reality of the labor market. It doesn't count millions and millions of people who are underemployed or have given up looking. So I would say that the true unemployment rate in the US is in the double digits, maybe in the mid-teens, I would have said. The other part of this number that the markets, the banks, the Fed, the mainstream economists look at is average hourly earnings. That's expected to rise from 0.2% to 0.3%. There's this Keynesian fallacy in mainstream economic fallacy that increasing, higher earnings result in inflation. It's such a huge fallacy, in my opinion. Inflation, of course, in the true sense of the word, the true definition of inflation is an increase in the money supply, created by credit, money out of thin air created by central banks and in the fiat money system. In a free market monetary system based on commodity money, or money that you can't create out of thin air, money that is like a merchandise or the most marketable commodity. It could be gold, silver, it could be seashells, it could be salt. When we have that, it's impossible really to have inflation. We have short-term fluctuations in the value of that money, but how much people earn is only a consequence of the government-created fiat money inflation, which results in workers actually asking for more money because they can't survive, because the value of their national fiat currency goes down. So I wanted to put that across. I don't believe it's inflationary. Let's say average hourly earnings comes out at 0.6 today instead of 0.3. I bet the mainstream Bloomberg, CNBC are going to say, oh, the Fed's definitely going to hike. We've got inflationary pressures coming from the labor market, which is a huge fallacy, especially when, almost 20% of working age Americans are unemployed or underemployed. I don't get that. So, that's the main number out at 8:30 Eastern Daylight Time or 1:30 London time. The markets this morning, gold and silver have rebounded fairly well. Gold is at $1233.50, up $6. Silver is at $16.40, up 8 cents. We have been higher. We got down up to $16.53. But as is usually the case when the U.S. starts coming in early on, silver starts getting, hammered a little bit or sold off. We also have the fixing for silver. There's only one fixing in the LBMA, and that's just going on right now at 12 o'clock. So once the physical market, I put that in quotations, in the LBMA fixes, you could see the futures come off. But yeah, gold and silver have rebounded. Was yesterday a bottom in gold and silver? We'll have to see. The other thing I've been looking at, the other reference or currency I've been looking at for the direction of precious metals is, of course, the Japanese yen. I spoke yesterday in the video about how, you know, the strength in the yen has been directly correlated with the strength in gold versus the dollar. And as the yen has weakened in the last, you know, since 17th of April, gold has also weakened. Yesterday, we reached a short-term high in the dollar or short-term low in the yen. We went up to above 113 in the dollar yen. So that means the dollar got to a new high. I know it's a little bit complicated talking about highs and lows, but it's a currency pair. And today, actually, early on, we almost, you know, we turned around right on that trend line. If you watch my video from yesterday in the Japanese yen, above 113, we turned around late yesterday. And this morning, actually, we got down to almost 112, which is a fairly big move. We got down to 112.08, but now the dollar's rebounded and we're at 112.42, but gold and silver are still holding quite well. The Dow is down 14, 20,930. S&P virtually unchanged, not much going on there. The euro, a little weaker, down 1/5% at 109.57. So, of course, the big news politically this weekend will be the second round of the French presidential election between Macron, you know, the banker's choice, and Le Pen, the populist nationalist. I do speak French, and I've read some of the French papers online, but they're all mainstream, and the reason why I read them is because I'm not familiar with the alternative media in France, so all I can see is the mainstream. I did listen to that debate the other day. It was quite heated. And right now, for example, IG Index, a spread betting firm in the UK, is giving Le Pen a 7% chance of winning, giving Macron 93% chance of winning. A lot like you know, before the EU referendum in the UK, and a lot like before the US presidential election, when the New York Times, I think, was giving Hillary Clinton a 95% chance of winning the day before the election. So it will be interesting. I think no matter who wins, we could see actually a bit of problems, social problems, upheaval, protests, riots in France. I think France is a very divided nation at the moment. So it will be interesting to see, you know, what happens. The results should start coming out, I guess, late Sunday, early Monday. I'm not too sure. What else? Yeah, I wanted to talk about a little bit about the welfare state and the fiat money system. You know, Greenspan did say in his Golden Economic Freedom essay in 1966 that the gold standard and sound money is the enemy of the welfare state or the welfarist. And I think it's still the case. And we are at a point where we've had the welfare you know, inflationary warfare, corporate state for so long that, you know, the government has gotten so big, central banks so powerful, the bullion banks, you know, the banks that control the central banks so powerful that they're trying to kill volatility because they're so scared, you know, because they've got so much so many bets on, so many derivatives, quadrillion of derivatives exposure, that if you create volatility, they could die off. But what that does is that, you know, that by trying to create stability, they could create huge instability, and it could come out of left field and no one knows where that's coming from. I know this has been said for a long time, but, you know, right now we have virtual markets. They're not real. They're just like pretend markets that central banks manipulate. You know, they control the interest rates, you know, and they're trying to like dictate, you know, the markets. And the reason they're doing that is to keep the banks afloat, because the banks, you know, hold huge amount of assets that basically went to zero and are really worthless, like mortgage-backed toxic securities. I think also government bonds are worthless. The only reason they're worth something is that the central banks are buying them. And it's, yeah, the problem with that is that one day something will just like click, and people will realize, you know, this is not Grace Kelly. This is a pig with lipstick on. And things will change. I don't know when that will happen. And I think, you know, the Grace Kelly of the financial markets is actually gold and silver. They're like, they've got a great track record. They're beautiful to look at and to hold. They're real wealth. They're not corruptible. They don't have counterparty risk. And one day it won't change. I know it sounds like a broken record, but you need to keep, you know, the big picture and you know, reality. So that's it. So we'll wait to see what this U.S. economic statistic on jobs comes out like. Of course, you know, is not really an indication in the real world, this number, but it does affect the reality markets of the big international banks and the central banks. And well, the big international banks are called the significantly important financial institutions, or SIFI. And they're run by the Bank for International Settlements in Basel, and they're above the law. They'll do anything, even the national treasuries in the UK, US, they'll do anything to keep those banks from failing, because they know if they fail, you know, the system is finished. You know, and I'm talking about HSBC, JP Morgan, Citigroup, Barclays, all those banks, Goldman Sachs. So they are above the law of, you know, the national law. They're controlled by the Bank for International Settlements, which is in Basel, Switzerland, but is completely above Swiss law as well. The Bank for International Settlements is a law unto itself. It was created in around 1930 during World War II. All the private central banks, even the German central bank, you know, had a presence there in Basel, and they did business together. You know, they financed the Germans, they financed the Allies, and at the end of the war, the Norwegian government said, you know, we can't have this bank. They financed both sides. And then the British delegation to, I think it was Bretton Woods or whatever, said, you know, under Mr. Keynes, said, no, we need to keep the Bank for International Settlements open. So, yeah, big, you know, I would say it's almost like a mafia. You know, the central banks and the SIFI banks, they're above the law. And no wonder, you know, they can keep doing whatever they want to the markets, including gold and silver. I know a lot of people think that it's no point in looking at technicals because of the manipulation, but I still think it's important to look at the technicals because you can get clues from it, and I know it doesn't work all the time, but I think not even these, you know, criminal cartel of bankers and central bankers can control the market forever unless they close the markets. So if you enjoyed this video, give me a thumbs up, share it far and wide. If you haven't subscribed to my channel yet, please do. In terms of donations, that it would be welcome. I have to tell you, like, there's this talk about Google and YouTube ad revenue. I'm still getting good revenue from most of my videos, but certain times when I bring, you know, the title of the video is like geopolitical or political, I get like 1/10 of the revenue that I get for videos about the markets. That's why I talk about the markets like I did now earlier in this video, and then I talk about, you know, the BIS and central banks trying to like avoid the algorithms that, you know, block or censor the content. So you might find it strange a little bit that I'm mixing these things, but I'm trying to like avoid the algorithms. So I'll talk to you later, and have a good weekend if I don't speak to you before. Bye.